The oil market is on the brink of a pivotal moment, but it's not what you might think. This weekend's OPEC Plus meeting is shaping up to be a quiet storm, with the group widely expected to maintain current output levels. But here's where it gets intriguing. While the decision seems straightforward, the underlying dynamics are anything but. Let's dive in. Yesterday, ICE Brent prices inched higher, surpassing $68 per barrel, and closing nearly 1% up for the day. However, this upward movement occurred during a period of low trading volumes due to the U.S. Labor Day holiday, raising questions about the sustainability of the rally. As the market's gaze shifts to the OPEC Plus meeting, the consensus is clear. Production levels for October are unlikely to change. This follows the group's gradual rollback of its 2.2 million barrels per day (BD) voluntary supply cuts over the past 6 months. With a surplus looming into next year, adding more supply seems off the table. But here's the twist. The real risk lies in OPEC Plus potentially reinstating cuts, driven by concerns over oversupply. What do you think? Is this a cautious move or a missed opportunity? Let us know in the comments. Meanwhile, in Brazil, a new development is brewing. Local media reports suggest the U.S. government is considering trade restrictions on Brazilian imports of Russian diesel. Since the EU's ban on Russian refined products, Brazil has emerged as a key buyer, importing over 590,000 tons of Russian diesel monthly this year, according to LSEG data. This raises a critical question. Could this move disrupt global diesel markets further, or is it a necessary geopolitical step? Share your thoughts below. Shifting gears to natural gas, European prices rose yesterday, with the Tidal Transfer Facility, GTF, settling 1.4% higher. Norwegian gas flows to Europe are under strain due to extended maintenance at the Troll field, reducing daily supplies to below 240 million cubic meters (MCM) per day, from 340 MCM per day in early August. Despite this, EU gas storage remains robust at 78% full, though below last year's 92% and the 5-year average of 85%. Is Europe prepared for winter, or are these storage levels a cause for concern? In the metals market, gold and silver are stealing the spotlight. Silver surged past $40 for the first time since 2011, while gold is inching closer to its April record of $3,500. Driving this rally are growing expectations of a U.S. Federal Reserve interest rate cut, with the upcoming jobs report on Friday likely to confirm a softening labor market. Tariff tensions, Fed independence debates, and a weakening dollar are adding fuel to the fire. Silver, in particular, is outpacing gold, with the gold-silver ratio narrowing to 85 from April's high of 104.7. Silver's 40% year-to-date gain and 7 consecutive months of ETF inflows highlight its momentum. But is this rally sustainable, or are we due for a correction? Finally, in agriculture, Australia is painting a bullish picture for wheat. The Department of Agriculture's latest report forecasts a 2025 grain harvest of 62 million tons, up 12% from previous estimates and 26% above the 10-year average. Wheat production is expected to hit 33.8 million tons, the 4th largest on record, thanks to heavier than expected rainfall. Western Australia's output alone is projected to reach 12.7 million tons. However, strong global supply from Russia and Europe has weighed on CBOT wheat prices this year. With such robust production, is the wheat market headed for a surplus, or will demand keep pace? Disclaimer: this content is provided by ING for informational purposes only and does not constitute investment advice, a recommendation, or an offer to buy or sell financial instruments. For more details, visit https://think.ing.com/about-content disclaimer.